Imagine waking up one morning and discovering that the silver market you thought you understood has completely transformed. For years, silver has been dismissed, overlooked, and undervalued by the majority of investors, while the world focused on stocks, real estate, and even gold. A powerful force was quietly building beneath the surface. Today, that force is beginning to erupt. The signs are everywhere. Industrial demand is surging, supply shortages are growing, and the global financial system is facing pressures unlike anything we've seen in decades. What if the biggest wealth transfer of the coming years isn't happening in technology, artificial intelligence, or cryptocurrencies? What if it's happening in one of humanity's oldest forms of money? A move to 100 silver would shock the financial world. A move to 500 would rewrite investment history. But a move to 7,000 would create a shockwave so powerful that most people simply cannot imagine its consequences. This isn't about hype. It's about understanding the forces that are reshaping the global economy. The question is no longer whether silver's story is changing. The question is whether investors are prepared for what may come next, because if the trends now unfolding continue, CLVR 7,000 SOKWAV may have already begun. For decades, silver has occupied a strange position in the financial world. It is one of the most important industrial metals on the planet, a precious metal with thousands of years of monetary history, and a strategic resource used in technologies that power modern civilization. Yet despite all of these characteristics, silver has often been treated as an afterthought by mainstream investors. While attention has repeatedly shifted towards stocks, bonds, real estate, cryptocurrencies, and even gold, silver has spent years building a foundation beneath the surface that many people fail to recognize. What makes the current environment different is that several powerful forces are beginning to collide at the same time. Historically, major moves in silver have occurred when monetary uncertainty, rising industrial demand, and supply constraints converged. Today, those same conditions appear to be developing simultaneously, creating a situation that deserves serious attention from anyone concerned with preserving and growing wealth. One of the biggest misconceptions about silver is that it is simply a smaller version of gold. While both metals share monetary characteristics, silver possesses an industrial component that gold does not. Every smartphone, electric vehicle, solar panel, medical device, advanced electronic system, and countless industrial applications depend upon silver's unique properties. It is the most conductive metal known to man, making it nearly impossible to replace in many critical technologies without sacrificing performance or efficiency. The world is becoming increasingly dependent on electricity. Every major economic trend seems to point toward greater electrification. Governments around the world continue to push energy transition policies. Corporations are investing billions into renewable energy infrastructure. Artificial intelligence requires massive data centers that consume extraordinary amounts of power. Electric vehicles require sophisticated electrical systems. Smart devices continue expanding into every aspect of daily life. Each of these developments increases demand for materials that make modern electrical systems possible. Silver sits at the center of this transformation. Unlike many commodities that can be substituted when prices rise, silver often performs functions that few alternatives can match. Manufacturers may attempt to reduce silver usage through innovation, but eliminating it entirely is frequently difficult, expensive, or impractical. This creates a situation where demand can remain resilient even during periods of elevated prices. At the same time, supply growth has struggled to keep pace with future expectations. Many people assume that when prices rise, mining companies can simply increase production and flood the market with new supply. The reality is far more complicated. Developing a new mine can require years of exploration, permitting, financing, construction, environmental review, and infrastructure development. Even when companies identify promising deposits, turning those discoveries into producing mines often takes a decade or longer. This delay creates one of the most important dynamics in commodity markets. Demand can increase relatively quickly, but supply frequently responds much more slowly. As a result, shortages can emerge and persist for extended periods. Adding another layer of complexity is the fact that a large portion of global silver production comes as a byproduct of mining other metals such as copper, lead, and zinc. This means silver output is not always determined by silver prices alone. Even if silver experiences strong demand growth, production may remain constrained because mining decisions are influenced by entirely different markets. This structural reality often surprises investors. They assume higher silver prices automatically lead to dramatically higher production. In practice, the relationship is far less direct. Supply growth can lag demand growth for years, creating persistent deficits that gradually tighten the market. Meanwhile, governments around the world continue accumulating debt at unprecedented levels. Debt itself is not necessarily a problem when managed responsibly. However, history shows that excessive debt eventually forces difficult choices. Policymakers can attempt austerity, increase taxes, restructure obligations, or pursue monetary expansion. More often than not, monetary expansion becomes an attractive option because it appears less painful in the short term. When currencies are created faster than productive economic output, purchasing power can erode over time. This is not a new phenomenon. Throughout history, societies have repeatedly experienced periods during which money lost value while tangible assets gained importance. Precious metals have often served as stores of wealth during such transitions because they cannot be created with a keystroke or printed into existence. Silver's monetary role remains deeply embedded within its history. Long before modern central banking systems emerged, silver functioned as money across civilizations. Merchants traded with it, governments minted coins from it, entire economies relied upon it. While today's financial system operates differently, the fundamental principles of scarcity and value preservation remain relevant. Investors are increasingly beginning to ask difficult questions about the long-term stability of fiat currencies. Inflation may fluctuate from year to year, but the broader concern centers on purchasing power across decades. People save not merely to accumulate numbers in an account, but to preserve future consumption and financial security. If purchasing power declines significantly, traditional savings strategies can become less effective. This concern becomes even more important during periods of economic uncertainty. Markets often function smoothly when confidence remains high. However, confidence can change rapidly when investors begin questioning assumptions they once considered unquestionable. Financial crises rarely emerge because everyone expects them. They emerge when expectations collide with reality. Silver has historically demonstrated sensitivity to shifts in confidence. During periods when trust in financial institutions weakens, demand for tangible assets can increase. Investors seek assets outside the traditional financial system, assets that cannot be diluted through policy decisions or balance sheet expansion. Another factor contributing to silver's growing importance is its relatively small market size. Compared to global stock markets, bond markets, and even gold markets, silver remains remarkably small. This characteristic creates both risk and opportunity. Small markets can experience significant volatility, but they can also respond dramatically when investment flows increase. Imagine even a modest percentage of global investment capital deciding to allocate funds towards silver. Because the market is comparatively small, the impact could be substantial. It does not require every investor on Earth to buy silver simultaneously. Relatively small shifts in allocation can produce outsized effects. Institutional investors have historically devoted limited attention to silver. Pension funds, sovereign wealth funds, insurance companies, and major asset managers generally allocate only a tiny fraction of their portfolios to precious metals. Should attitudes begin to change, demand could increase significantly without requiring widespread public participation. The psychology of markets plays an equally important role. Most investors are comfortable buying assets after prices have already risen substantially. Human nature encourages participation during excitement rather than accumulation during neglect. This tendency creates opportunities because markets often experience their greatest potential before widespread recognition arrives. Silver has spent much of its recent history operating outside mainstream financial discussions. Television networks devote endless coverage to stock indexes, technology companies, and economic forecasts, yet silver frequently receives minimal attention. Ironically, this lack of attention may represent one of its greatest strengths. Major bull markets often begin quietly. They start when fundamentals improve while public interest remains low. As conditions strengthen, informed participants gradually increase exposure. Only later, after substantial gains have already occurred, does broader participation emerge. The energy transition represents another force that deserves careful consideration. Solar power installations require significant amounts of silver. As countries pursue renewable energy goals, demand from the solar sector continues expanding. While manufacturers constantly seek efficiency improvements, overall deployment growth has frequently offset reductions in per unit silver usage. The scale of global energy transformation is enormous. Nations are investing trillions of dollars into infrastructure upgrades, grid modernization, battery technology, and renewable generation capacity. These initiatives create long-term demand drivers that extend far beyond short-term economic cycles. Artificial intelligence introduces additional demand considerations. Advanced computing infrastructure requires sophisticated electronics, data transmission systems, and power management technologies. Data centers consume vast quantities of equipment containing silver and other critical materials. As AI adoption accelerates, supporting infrastructure must expand accordingly. Medical applications further strengthen silver's strategic importance. Its antimicrobial properties make it valuable in healthcare settings. Wound care products, water purification systems, and specialized medical technologies. These uses may not attract headlines, but they contribute to consistent underlying demand. Perhaps most importantly, many of these demand drivers operate independently of one another. Renewable energy growth does not require AI expansion. Medical demand does not depend upon electric vehicle adoption. Monetary demand can increase even if industrial demand remains stable. When multiple demand sources converge simultaneously, pressure on available supply can intensify. Market participants often focus heavily on short-term price movements while overlooking long-term structural trends. Daily fluctuations generate headlines, but lasting bull markets are typically driven by fundamental imbalances that develop over years rather than days. The silver market appears increasingly influenced by such structural forces. History demonstrates that commodity shortages rarely announce themselves in advance. Inventories decline gradually. Production challenges accumulate quietly. Demand grows incrementally. Then, at some point, markets recognize the imbalance and price discovery accelerates. The hidden crisis surrounding silver is not necessarily a single event. It is the gradual realization that future demand expectations may be colliding with supply realities in ways many investors have not fully appreciated. It is the recognition that monetary uncertainty continues growing while strategic resources become increasingly valuable. It is the understanding that a relatively small market faces potentially enormous demand from multiple directions simultaneously. Most people focus on today's price because it feels tangible and immediate. Far fewer examine the conditions that determine tomorrow's price. Yet markets are ultimately driven by future expectations. Investors who understand emerging trends before they become obvious often position themselves differently than those who wait for confirmation from headlines. The silver story is no longer confined to precious metals enthusiasts or commodity specialists. It increasingly intersects with energy policy, technology development, industrial manufacturing, monetary stability, geopolitical competition, and global investment behavior. Each of these themes influences the metal's future in meaningful ways. When viewed individually, any single factor might appear manageable. Industrial demand alone may not transform the market. Monetary concerns alone may not create historic price movements. Supply constraints alone may not produce extraordinary outcomes, but when these forces operate together, they create a framework that deserves attention from serious investors seeking to understand where the world may be heading. One of the most important forces shaping the future of the silver market is a challenge that many investors still underestimate: the growing difficulty of increasing supply in a world where demand continues to accelerate. Most people assume that if the price of any commodity rises high enough, producers will simply create more of it. While that assumption may sound logical, the reality of the silver industry reveals a far more complex situation. The truth is that bringing significant new silver supply to market is becoming increasingly difficult, increasingly expensive, and increasingly time-consuming. For years, silver demand moved in relatively predictable cycles. Industrial usage expanded gradually, investment demand fluctuated with economic conditions, and mine production generally kept pace. Today, however, the landscape is changing. New technologies, global electrification projects, renewable energy initiatives, and growing concerns about financial stability are creating demand pressures unlike anything the market has experienced in previous decades. To understand why supply is struggling to keep up, it is necessary to understand where silver actually comes from. Many people imagine vast silver mines operating around the world extracting silver as their primary product. While such mines do exist, they represent only a portion of global production. A significant amount of silver is produced as a byproduct of mining other metals, particularly copper, lead, zinc, and gold. This creates a unique challenge. Silver production is often dependent on decisions being made in entirely different industries. A copper producer may not significantly increase output simply because silver prices rise. Their primary concern remains copper economics. If copper demand weakens or mining operations become less profitable, silver production can suffer regardless of how strong the silver market appears. This structural dependence limits the industry's ability to respond quickly to rising demand. Unlike a product that can be manufactured in a factory with expanded production lines, silver requires geological discoveries, mining infrastructure, processing facilities, transportation networks, environmental approvals, and massive capital investments. These processes cannot be accelerated overnight. The timeline for developing a new mine often surprises investors. From initial discovery to commercial production, a project can take 10 years or more. Exploration companies must first identify promising deposits. Geologists analyze samples and estimate reserves. Engineers determine whether extraction is economically viable. Environmental studies are conducted. Permits are secured. Financing is arranged. Infrastructure is built. Equipment is installed. Workers are hired and trained. Each step introduces delays, risks, and costs. Even after a promising deposit is discovered, there is no guarantee it will ever become a producing mine. Many projects fail due to financing challenges, regulatory obstacles, environmental concerns, political uncertainty, or unfavorable market conditions. The journey from discovery to production is filled with potential setbacks. Meanwhile, demand continues moving forward. Governments around the world are committing hundreds of billions of dollars toward renewable energy expansion. Solar energy remains one of the fastest growing sectors requiring silver. Every solar panel contains silver because of its exceptional conductivity. Although manufacturers constantly work to reduce silver content per panel, overall demand continues to grow as installation volumes increase. The scale of planned solar deployment is enormous. Countries across North America, Europe, Asia, and the Middle East are investing heavily in renewable energy infrastructure. These investments are not measured in millions of dollars, but in trillions. Every new project contributes additional pressure to silver demand. Electric vehicles create another layer of consumption. Modern vehicles contain significantly more silver than many traditional automobiles because of their advanced electrical systems. Charging infrastructure also requires silver-containing components. As nations pursue transportation electrification, silver demand expands beyond vehicle manufacturing itself and into the broader ecosystem supporting electric mobility. Artificial intelligence is generating demand from an entirely different direction. AI requires massive computing power. Data centers must expand. Servers, processors, networking equipment, cooling systems, and power management technologies all rely on components that incorporate silver. As AI adoption accelerates globally, infrastructure requirements continue growing. Few investors consider the combined impact of these trends. Renewable energy growth alone is significant. Electric vehicles alone are significant. Artificial intelligence alone is significant. Telecommunications expansion alone is significant. Medical technologies alone are significant. When all of these sectors simultaneously require increasing quantities of silver, the cumulative effect becomes substantial. The mining industry faces another challenge that receives relatively little attention: declining ore grades. Historically, many of the world's richest deposits were discovered and developed first. Mining companies naturally focused on high-grade resources because they offered superior economics. Over time, however, many of these deposits became depleted. New discoveries often contain lower concentrations of metal, meaning more material must be extracted and processed to produce the same amount of silver. Lower ore grades increase costs. More energy is required. More equipment is needed. More labor is necessary. Environmental management becomes more complex. Water consumption can rise. Processing facilities must handle larger volumes of material. As ore grades decline, maintaining production becomes increasingly difficult. At the same time, mining companies face inflationary pressures affecting virtually every aspect of their operations. Fuel costs fluctuate, labor expenses rise, equipment becomes more expensive, regulatory compliance requirements expand, construction materials increase in price. Financing costs can become burdensome when interest rates rise. These realities affect investment decisions throughout the industry. Building a new mine today often requires billions of dollars in capital. Investors and lenders demand confidence that projects will generate acceptable returns. If uncertainty exists regarding future regulations, political stability, taxation policies, or environmental requirements, financing can become difficult to secure. Geopolitical risks add another layer of complexity. Many important mining regions operate within jurisdictions facing political instability, changing regulations, resource nationalism, or social unrest. Governments sometimes seek greater control over natural resources. Tax structures may change unexpectedly. Permit approvals can face delays. Local opposition can emerge. Infrastructure challenges may complicate development. Each of these factors increases risk and slows supply growth. The world is also becoming increasingly aware of environmental considerations. Modern mining projects must satisfy stringent standards regarding land use, water management, emissions, biodiversity protection, and community engagement. While these objectives are understandable and often necessary, they can significantly extend development timelines. A mine that might have been approved relatively quickly decades ago may now require years of additional studies, consultations, and reviews before construction begins. This reality creates a paradox. The global economy wants more silver for renewable energy systems, electric transportation, advanced technology, and modern infrastructure. At the same time, the process required to develop new silver supply is becoming slower, more expensive, and more complicated. Recycling provides some relief, but it cannot fully solve the problem. Silver is recycled from industrial waste, electronics, jewelry, and other sources. However, many applications use extremely small quantities of silver dispersed throughout products. Recovering these amounts can be economically challenging. In some cases, the silver content is simply too small to justify recovery costs. Furthermore, demand growth can outpace recycling expansion. Even substantial increases in recycling efforts may struggle to compensate for rapidly growing industrial consumption. The gap between supply and demand can persist despite improvements in recovery technologies. Market inventories represent another important factor. When production fails to meet demand, inventories can help balance the market temporarily. Stockpiles accumulated during previous periods may satisfy short-term shortages. However, inventories are not infinite. Persistent deficits gradually reduce available reserves. As inventories decline, market flexibility decreases. Small disruptions that might previously have been absorbed easily can suddenly produce significant consequences. Supply chain interruptions, geopolitical tensions, transportation challenges, labor disputes, or unexpected demand surges become more impactful when inventories are limited. History shows that commodity markets often remain calm until inventories reach critical levels. Then perceptions change rapidly. What previously appeared to be a manageable imbalance becomes recognized as a genuine shortage. Investor behavior can amplify these dynamics. For years, many investors have largely ignored silver. If growing awareness of supply constraints begins attracting broader investment interest, demand could increase beyond industrial requirements alone. Investment demand differs from industrial demand because it can respond quickly to changing perceptions. A manufacturer may purchase silver according to production schedules and operational needs. Investors, however, can enter markets rapidly when they perceive opportunity or risk. Even a relatively small shift in global investment allocations could create substantial pressure within the silver market because of its comparatively small size. The silver market is tiny compared to global equity markets, bond markets, real estate markets, and currency markets. Trillions of dollars circulate through financial systems every day. If only a small fraction of that capital seeks exposure to silver,